Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Damian Graham, Chief Investment Officer at First State Super. Damian, welcome.
Thanks, Alex. Nice to be here.
So I thought I'd kick off with the name change. Obviously, First State Super has just announced that the name will be changing to Aware Super in September. I wonder if you could give the listeners a backdrop to that name change and what was the thinking behind it.
Thanks, Alex. And again, by way of background, clearly First State Super has been around for quite some time, and more recently, in the last couple of years, there has been some acquisition with State Plus, and even more recently, 30 June this year, we merged with Vic Super. And I guess it's a great time for us to sit back and think, well, how do we want to be positioning ourselves from a brand perspective? And so we reflected on that and have decided to go through a rebranding process, as Alex mentioned, in September of this year. So really exciting times. And one of the things that I think is always critical with any brand is that the name is only one small part of it, and it really is about the why and the story that supports that brand. And I think when we sat back as an organisation with Vic Super and thought about what do we want to be known for and what would our name be in future, we felt that we wanted something that really did portray and reflect our organisation, the purpose we have, and really how we think about serving our members. And we know that our membership, being the nurses, the teachers, the carers, the protectors in our communities, we felt that Aware was a very aligned name that reflected the purpose we have. And we do feel we're a very purpose-driven organisation, and so is Vic Super. So why the merger was such a good fit, whereby we wanted to come up with one name across the three organisations, where eventually we'll be known as Aware Super. And it really does reflect that awareness our members have, the awareness we want to take for all sorts of different issues, whether it's around environmental issues, whether it's around worker rights issues, whether it's around how to make our members as aware as they can be around the future they have and their retirement. So we felt it was a very nice fit for what we've always tried to do as an organisation, and also what we're going to try to do in future as we continue to grow in size and influence.
So as part of that naming change, you announced a lot of targets and actions that will be coming more specifically around energy and climate. Can you give a bit more context on what you've announced?
Absolutely. So we did, at the start of this month, announce an updating of our climate change portfolio transition plan. So we put our initial plan together about 5 years ago or so. And what we felt at the end of that 5-year period, it was very timely for us to review, and we've been doing that over the last few months, review our targets and activity, and really look at how we're going to set the portfolio well for now and as the economy transitions to a lower carbon future. So when I think about the work we do around our responsible ownership, which is how we think about delivering a great long-term return, but also doing it in a way that our members would feel is appropriate and proud of, we think of 4 key areas. And so those 4 key areas include how we think about managing the environmental, social and governance risks, so the ESG risks, how we think about investing in investments that can increase a positive impact or have a positive impact, but also reduce the negative impact of other investments, how we can engage with the assets we own, whether that's a corporate asset, a listed company, for instance, or an unlisted business, and how we can advocate with government and policymakers to drive positive societal change. So our portfolio transition plan contemplates each of those areas and activities and sets purposeful activities and some targets to try to affect a positive change from the environmental perspective over the longer term. So if you look at some of the specifics, we've got a target to support the economy to transition to a 45% reduction in carbon emissions by the year 2030. We would also like to see our portfolio replicate that reduction over that time frame. And to do that, we've set some shorter term targets. One simple one is that we've decided to divest from thermal coal producers. We've also decided to reduce the carbon emissions from our listed equity portfolio by at least 30% over the next 3 years. So we have quite a strong target to reduce that. And we'd expect that to increase in the size of reduction over the ensuing years post 2023. What also we want to do from an unlisted perspective is really benchmark the assets, the key assets we own, and then understand how we can reduce their carbon intensity or carbon emissions. And they may be, it may be an airport, it may be an industrial property, it may be an office property. It may be an operating business where we're looking at how we can reduce the carbon emissions from those businesses to support that transition for the economy and our portfolio towards that target, that aspirational target of a 45% reduction over the next decade.
Let's go into sort of the broader portfolio. You've given the impact across a number of asset classes there in terms of infrastructure and real estate and how that may change. Mm-hmm. Is there a possibility that these restrictions on the carbon amount that you can invest in, or the amount of mm-hmm. impact, that limits the potential for sort of greenfield projects in real estate or in infrastructure?
Look, I'd say it's probably the opposite, Alex, with regard to eliminating greenfield. But if I think about, from my perspective, the way that I touched on before of our key investment focus, we term it as responsible ownership. And that starts with our fiduciary duty of good long-term returns to our members. So we know that's the critical deliverable that our members rely on us to deliver for their retirement. So, our investment focus starts with how do we generate strong long-term returns, and then turns very quickly to, in doing that, how do we ensure that we're also having a positive community or societal impact? And we think that can happen in a very virtuous circle, whereby we can generate strong long-term returns, but also have that positive impact. And if we do that well, we also think that we can improve the risk-adjusted returns of the investments we're making. So a really simple example is investing in an infrastructure or property asset that we don't think is well set up for the transition to a lower carbon future may actually suffer a reduction in value if it's not in the right position, or it's not an asset that can manage that transition well. So in everything we invest, we do appropriate scenario planning and testing to ensure that we feel that those investments are well positioned from an ESG perspective, so that there aren't unintended risks in those assets that can see their future value fall if we do see the likely outcome where we've got to reduce the carbon emissions of the portfolio in total.
Do you feel that will change how you construct a portfolio? Because what you're describing here in terms of individual assets, that sort of changes the nature of the portfolio from more of a bottom up, think about individual assets that you're putting together as opposed to risk factors?
Yeah, look, I think it does, but it's been a longer term journey. So, it's not like we've woken up today and said, gee, we need to think about ESG issues when we do our due diligence around a new investment. We do have a blend of the top down and the bottoms up. So every asset where we look to buy, whether it's a new unlisted asset or it's a different style of investment, we have a consideration around the ESG, and climate will be one of those facets or factors that we very much consider. We do think about it in a broader portfolio context as well, though, and we think about the total. And we think about, or I think about, managing our broader portfolio so that the 120 billion or so today from a budget's perspective. So, we have a multitude of budgets that we're looking to optimise for, get the best outcome in allocating those budgets. And it may be the risk budget, it may be the liquidity budget, it may be the fee budget, it may be the exposure budget. So who are our counterparties and how do we make sure we've got the right blend of counterparties? It may be, our carbon emissions budget, which again we're looking to moderate through time. So how do we ensure that our portfolio is best positioned to think about the risks that transition will pose, And so how do we make sure we're allocating money to best manage that risk? So those budgets are something that we think about every day from a top-down perspective, but they also have the implications of the bottom-up asset selection or security selection perspective as well.
As you look into sort of the various ESG metrics, is that something that you guys will be doing internally, or you'll be using external parties to help as you start to do this analysis?
Yeah, so we do. It's interesting. For our carbon emissions reduction target for our listed portfolio, we've actually created that intellectual property internally, where we've defined a benchmarking framework which allows us to have that reduction. And we've used our internal systematic equities team to do that. And then we've provided that intellectual property to a benchmark provider to develop a benchmark that then our passive managers and our internal managers can follow. So it has been a nice example where we've been able to use the capabilities we've built internally from an internal investing perspective to develop a benchmark that we can then follow for our listed equities. So that's been a really nice leverage point on some of the capabilities we've been building up over the last 5 or 6 years. But we also do use external providers as well. So, it may be someone like an MSCI, or it may be for our international engagement, we use Hermes, for instance. So we certainly don't believe that we can do all of these activities ourselves. And we think there's a really good opportunity for us to buy in the right expertise and to utilise that to deliver better outcomes for members.
You mentioned there about sort of using a number of partners. Is there any efforts to maybe partner with maybe local asset owners that are doing some very similar work?
Yeah, and look, I mean, we certainly sit on a number of collective groups that are focused in different areas, but it could be climate related, could be governance related, it could be proxy voting related activities. So we certainly do sit on a number of boards or collective organisations focused on those sort of issues and sharing information and making sure that we're all developing and supporting the journey as best we should. We also do collaborate with different organisations, whether that's other asset owners domestically. We do have a lot of collaboration with asset managers, for instance, and that can be very useful, obviously, with regard to not just ESG-related issues, but broader research and investment research issues. But we're very open to making sure that we can collaborate and learn and get value from different asset owners as well. And, I think we don't think that we can achieve the reduction or the goal that I mentioned before, which is a reduction of carbon emissions for the economy by that 45% in the next decade. We certainly can't do that ourselves. So we very much feel that the more we can collaborate with institutional investors, other asset owners, and there is a lot of alignment in that group around, the goal to have a lower carbon future, that we think that we're going to be more successful or more likely to be successful in that endeavour.
Yeah, as you think about all these issues around ESG and the amount of new factors you need to take into considerations gets larger, do you feel that the portfolio will become almost more concentrated in where you would like to be more active in sort of the investments that you take?
It's interesting, Alex, because the way that we think about portfolios, or I think about portfolios, is in a hybrid context. So, our investment belief states that we don't think there's only one way, or there are many ways to invest. And so those many ways to invest may include active and passive. It may include listed or unlisted. It may include external management or internal management. And so what we're trying to do across each of our sectors is define the best hybrid approach of all these different ways of investing that we feel is the most likely to deliver our return outcomes, our return objectives. And so in some ways, and as we grow larger, I guess one of the things we also contemplate is how do we invest increasingly larger size of funds to be able to generate those long-term outcomes our members need. So we do think about that concentration risk very actively, because I do think there is the risk that as you start to adjust portfolios or exclude various things, or even have targeted outcomes, you can have unintended consequences around the concentration risk. One of the concentration risks that I've been focused on now for probably the best part of 7 or 8 years is just the residential property risk in Australia, because I do think that Australian asset owners and larger investors tend to have quite a high bias towards that factor, and so we think about spending our allocation to that risk as wisely as we can. Obviously, we think there's great opportunities for good outcomes, but we also know that cycle has very strong implications for investment markets in Australia, particularly. So that global diversification is a benefit in that light.
It's interesting that you mentioned the residential property risk, and that's obviously a big one with banking sector, with the banking sector being such a large part of the Australian economy as well. And that sort of opens up a different part of the ESG equation, particularly on the S side. You know, how do you sort of think about where does that S framework, how do you apply that to particular investments? Because in the case of banking, it gets really difficult to sort of work out, oh, hold on, they provide loans, but are they providing loans to mining companies that have high carbon, or are they providing loans to people that can't afford to pay? And there's a social construct that, you know, plays out there. How do you think about the S in this framework?
Yeah, and one of the things that we do, Alex, as a investment function, is we do undertake specific research or have specific focuses. So if you look at our focuses over the last year or two, it has been around climate transition, it has been around housing affordability, it has been around worker rights, and finally around conduct and culture. And the conduct and culture piece is very, very relevant to what you're raising around the S, the social piece, the social license to operate with any listed company. But obviously the banks are a good example, but all organisations are relevant there. And we've undertaken some research and defined what we think is an appropriate process to try to ensure that we understand the best way to think through an organisation's conduct and culture, because we think that's a great indicator of future value. And it can be at a very blunt level through a loss of the licence to operate. It could just be through a cultural impact on their efficiency and the way they can grow their market share or their earnings in future as well. So, you know, it can be more gradual than that. But we do think that that's a very critical issue, the culture of an organisation and the way that they conduct themselves as to the positivity or the positive potential for that as an investment.
Do you feel more pressure, you know, as a CIO in terms of trying to take into consideration all these factors when you also got a broader fiduciary duty to maintain?
Well, I think, as I said earlier, it does very much start with making sure we are targeted to generate the financial outcomes our members need. So, as I said earlier, though, the risk-adjusted return we feel can be bettered. There can be a better risk-adjusted return. So getting a better return for the risk we're taking via understanding different risks. And there are additional risks we're contemplating today than we did 10 years ago as investors. You know, the social issues, as you mentioned, the environmental issues, as you mentioned, have certainly increased in their focus. I think ESG was very much dominated by the governance risk 10 years ago. I think now it's a much more even blend of the E, the S, and the G. And I think it's important. But I think it's important in very strong focus because we think it can improve the risk-adjusted return we can get for our members and reduce some of the downside risk if we manage those ESG risks as well as possible. So I think it's an important issue. Is it more complex? Probably. But investment markets are complex by their nature. So, you know, we're always trying to ensure that we adapt as we need to think through the risks and the opportunities, because these things throw up opportunities, not just more work, but they certainly, if we're able to manage and understand these risks as best as possible, we think it will offer us some opportunities for new investments as well.
Are you finding much trouble in terms of finding opportunities, particularly in the renewable space? I know a couple of funds have sort of mentioned that there's more opportunities globally as opposed to locally for renewable energy. Are you finding the same sort of issues?
Yeah, look, I'd say that, the Australian market in a number of different ways is is a smaller market than the global market. Clearly, that's an obvious statement. So I think that for renewables or for even some other areas, technology, health, those sorts of things, clearly it's a smaller market. We made our first direct renewables investment in the last 6 months or so, and it was a sizable investment in the scheme of things. We've made around the world less directly, mainly through funds. We've got additional exposure to renewables, and also we've been focused on trying to invest in technologies that can support that climate transition as well. So, we've got some exposure there, and I'd say that we think there's a good prospect of making more investments, both the renewables and the technology, the supporting technology side. But it's not a huge part of our portfolio, and I've got a stated objective to invest about another $500 million into renewables or transition technologies over the next 3 years. So that's a significant amount of money in the Australian context. Obviously, it's not a huge amount of money for our fund, but we think it's an important investment, and it is a growing market. So we do think that there's going to be more opportunities. I think also it's important that we build an understanding of that marketplace, and it is quite complex, the renewables market in Australia, and so we do feel that it's an important one to really continue to invest into and build our expertise so that we can take these opportunities in future.
So you've had historically, I don't know if you're going to continue, a sustainable investment option, and then you've got the normal balance fund. Given you mentioned that there are limited opportunities, does it make sense that most of those opportunities then sort of sit behind the SRI fund, or do you merge the two? How do you think about sort of those two funds operating?
I think that the way that I've thought about it is that the SRI option is very much for people that would like to have a higher level of explicit exclusions in the portfolio. But I think the broader portfolios, the bulk of our assets, I think the direction is that we want to continue to embed the ESG risk management into those broader portfolios. So I think that my gut feel is that the broader options will start to, take on some of the characteristics of the SRI option, but the SRI option today is a more purpose-built from an exclusions perspective. We do use some of the positive facets and factors in both portfolios. So, as I said, there's a direction where the broader portfolio starts to take on some of the positive attributes of the SRI, but it's not our purpose. It's not our suggestion that we would stop issuing or offering the SRI option anytime soon. So I think that my view is that there's a strong opportunity for that option for members that want to make that choice.
Just going a little bit deeper into the SRI option, is there particular differences in the trustee documentation around that fund with respect to, for example, social housing, where the housing has got a lower rental rate than maybe a market rate? Is that how you can potentially address the social impact / financial trade-off?
Yeah, so we, and you may be mentioning, so we have a strategy that we're executing at the moment, which is to invest in affordable housing for key workers. That doesn't just sit in our SRI option, that sits across both portfolios. So, we feel like that's a good investment, and obviously it needs to be a good investment from a risk return perspective. And so we've invested across all options in that particular strategy. And we feel that it is a very strong opportunity for us to build into a marketplace where we think the rental predictability is very high. So we think there's a low risk of vacancy rates in that, because again, we are renting those to key workers at below the normal market rates. But for the other side of that, we've been able to do that and rent them very quickly and have incredibly low, effectively zero vacancy rates, even in a market right now where we're seeing residential or rental and vacancy around residential properties increase. So we haven't experienced that, and so it's a very positive experience for us in that affordable housing outcome. which we think will deliver a really strong long-term return for members. And we're looking to build more of those or buy and build more of those because we think it's a very attractive part of the property cycle and part of the property sector, given everything that's happening across retail, office, and uncertainties around COVID impacts there. And obviously, the industrial market, which we have significant exposure to, but feels pretty fully priced given the way the property sector has been focused on that in the last 5 years or so.
Let's stick to the property space and also sort of the renewable. How do you think about the whole supply chain as you think about investments in these areas? Obviously the environmental, the output of reducing carbon's one piece, but there's the whole supply chain that goes into building, for example, a new apartment block or even a renewable solar farm. How do you sort of factor in all those parts of the project?
And are you talking about the associated emissions in production or?
Correct. There's the whole supply chain as you think about the minerals, the process in creating the solar panels, the whole life cycle of the items that are used.
It's interesting because one of the things that we've been undertaking in the last 12 months or so as a specific activity and will form part in future of our climate transition plan is an impact measurement framework for our real assets or our direct assets. So it's trying to contemplate what you're talking about, Alex, which is understanding what's the impact of the airport we own in Western Sydney, for instance, or an industrial asset or an agricultural asset. So trying to really understand what the impact broadly is. And it's not just around climate. It may be the employment impact. It may be the environmental impact around water usage. It could be energy usage more broadly. So we're trying to contemplate the sort of broader lens of the impact for those assets, exactly along the lines of what you're saying, so we can understand the downstream. And we think by doing that process, we'll just build a greater understanding of what options we've got to support a better outcome in future.
Mm-hmm. Yeah, look, the reason I asked the question is that there has been sort of some debate around electronic vehicles that, yes, they're great and they're fantastic in the sense that they reduce carbon while you're using them, but there's a lot of carbon that goes into to build the car at the time. The energy often is used by some very high intensity fuels and gas and so forth to convert it into energy. And then on the end, you've got the battery that is wasted effectively. So that was why I mentioned it.
I think that's a really good point. So, we do need to do the detailed analysis as to the fuller footprint. And it's not just about the end usage. We need to consider that. We've been undertaking research on a number of different themes, but certainly in the energy space. And it could be around gas as a transition asset, for instance, because clearly that's an important asset or an important energy source today for Australia. But we want to have a view, or want to take a view as to what's the complete picture around gas as one example, when we're thinking around how we should invest across the energy cycle or the energy sector.
It's interesting you mentioned gas because that is a big part, obviously, of the Australian economy as well. So how do you then sort of think about it for First State Super? Your members aren't directly related to that area, but there are a number of super funds that really wrestle with this problem because it directly affects their members from an employment point of view.
Look, I think it's a really big issue for us and all investors in that, as we transition to a lower carbon future, we do need to actively consider how we can support employment. We've undertaken an initiative with the Victorian government, which is called the Victorian Business Growth Fund. And that's a fund that we've established. We've committed $200 million to it, the state government of Victoria, $50 million. And that pool of assets is there to support business growth for small, medium enterprises, because we know how important employment is, particularly in that area of the employment market. And so I guess we feel that the most successful economic outcome, particularly as we recover from COVID, will be where we can support employment, and we can certainly support small businesses to hold on to employees. So, we do think that transition to the future has to contemplate how we can make sure employment is supported and maintained through time. And so that transition is a really critical one. I think it's very difficult, but it's one that we feel is going to need quite a lot of focus. Obviously, the government's very focused on it, and I think investors are and should be as well to think through how to invest to support economic growth and obviously to support employment as well. And that Victorian Business Growth Fund is one smaller initiative we've undertaken to try to lean into that issue.
You mentioned the government there, and that was going to be my closing question actually around sort of the role of superannuation and nation building, and what potentially you would hope to hear from the government to maybe sort of work more closely with super funds to sort of invest in larger maybe infrastructure projects or create some other sorts of affordable housing. How can superannuation help in sort of getting the economy out of this current rut due to COVID and start to re-employ people again?
Yeah, I absolutely agree with the question or the comment that we feel there's a need for all parts of the economy to contribute. So whether that's the government, whether that's private companies, private employers, businesses investing, or whether that's institutional investors, super funds, I think there's a great opportunity for contribution across each area. And as coordinated as it can be from a policy and activity perspective, we'd expect to see the best outcomes. And those outcomes will take time. Obviously, we're facing into an economy where there's likely to be heightened unemployment for quite some time. So, we do need to support that employment. And so I think policy certainty is always critical, whether it's around climate, whether it's around climate-related policy, the direction of how to invest, and the certainty that the investment assumptions will last. Because when we invest money into a particular opportunity or area, there's always the need to make assumptions. So the more accurate those assumptions can be, where they're based on policy, the more likelihood is that members will get the returns that they're expecting, and we can generate those returns. So that policy certainty is critical. Climate's one. Certainly, the way that state governments and federal governments will think about development areas. The New South Wales government announced their renewable zone, so those initiatives are really interesting, and again we'll understand what options that may offer us. Certainly, also infrastructure more broadly with regard to infrastructure opportunities and where they may fit. We certainly are looking to invest some additional funds. We've defined our capacity to invest in opportunities that aren't just within our normal strategic asset allocation or our normal portfolio makeup. And that's a reasonably substantial amount of money that we think we could invest should we be able to find attractive opportunities. And again, the point that you started with, Alex, is a critical one. Those opportunities need to be able to drive a good long-term return to our members so that we can meet the fiduciary duty we have as a fund. But subject to that, we'd love to be investing more to support economic growth and supporting employment.
Mm-hmm. All right, that's been a fantastic conversation. Thank you very much for your time today, Damian.
Thanks for yours, Alex, and take care.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.